Hello and welcome to an FX Times Daily Fundamental Market Recap. I'm your market analyst Nick Nassad. Today is Friday, December 4th, 2009. Let's start today's broadcast with the big news for the day, which was today's non-farm employment change for the month of November from the U.S. Non-farm payrolls dropped by a seasonally adjusted 11,000 for the month, which was a much better figure than expected. We also saw the figures for September and October revised to show that job losses were lower by a total of 159,000. With those revisions and today's better than expected figure, the unemployment rate dropped to 10% from 10.2% in October. If we count the number of discouraged workers and those forced to work part-time, the rate there fell to 17.2% from 17.5%. So that's still a very high and elevated level, but at least it fell as well. In a rundown of some of the key industries that either gained or lost jobs, we saw that the services sector added 58,000, while goods producing sector lost 69,000, 27 of those in construction and 41,000 in manufacturing. Temp hiring was up by 54,000, and we saw a larger percentage of industries higher. Also, hours worked increased, as did overtime hours worked. So the increase in temp employment plus hours means that firms may need to start hiring full-time staff soon as the economy recovers. We've had encouraging developments in the jobless claims data recently, with this week showing the second week in a row that we were below 500,000. And as we look on the chart to the right, we see that the overall trend has been improving since early this year. And we may be set to see some actual positive job growth in December. So let's take a look at the impact in the currency markets. Here we're looking at the euro-dollar pair with 30-minute candles, and we see that we had a very strong surge in favor of the greenback following the news. Now, for the most part this year, when we had positive economic data, whether it came out in the US or in other countries, the greenback has usually weakened as it increased risk appetite, and it caused traders to put on risk trades or carry trades. This time we had a very different result, as the non-farm payroll report is one of those, since it's the most important indicator that traders are looking at. It can actually shift expectations around the U.S. recovery, and when it does that, it shifts the expectations of when the Fed will begin to tighten its monetary policy. Higher interest rates in the U.S. should favor the greenback, and currently interest rates are near zero. So any change in those expectations is important. So we're going to see next week how Fed officials respond to the data and whether we have any hawkish comments from some of the policymakers on the FOMC. If we zoom this pair back a little bit, we see that our support today came from our low in last Friday's trading following the situation in Dubai where the greenback gained on risk aversion. Today, the greenback gained for much different reasons, obviously the non-farm payroll release. Now, we did have the ECB in yesterday's session after the ECB interest rate decision say that they too were beginning to tighten some of their loose monetary policy, which includes that the rates on its last 12-month tender will be tied not to a fixed 1%, but to the average of its benchmark rate over the year. Plus, they said that their final 6-month tender operations will be held in March. So those are the first steps that the ECB is taking to tighten its lending, while today is more based on expectations from what traders and investors think the Fed could do instead of anything the Fed has actually said. But again, if jobs begin growing and the labor market begins to improve, it definitely boosts the chances for a stronger recovery, and that would mean higher interest rates in the US. Here we have the dollar-yen pair, one of our other major currency pairs, and we see that the greenback strengthened in this pair as well, breaking above this support turn resistance level that we had shown in yesterday's video. We also saw this upward sloping trend line as the yen had been weakening all week against most of its other rivals following its gains in in last week's late trading. The level that we reached today was our high from back here in early November. Let me throw a horizontal line here. So we could see it was around the 90.75 level. So following this slide in this pair, we'd have seen Japanese, both the Prime Minister and others, make comments that this slide in the yen was detrimental to the recovery there, and many had begun considering that the Bank of Japan would intervene in the markets. We did have the Bank of Japan in Tuesday's trading announce extra liquidity measures that weakened the yen, but today was, as this resistance trend line and this support trend line converged, we did have a nice breakout to the 90.75 area in today's trading. As I mentioned, the yen was weaker against its other rivals. Here we're looking at the pound-yen pair, and we see that from the low overnight, we rose around 320 pips in today's trading, and it too moved above some important resistance levels, mainly yesterday's high and this period of consolidation that we saw in early last week around the 148.30 level. So we had this resistance here, and now it actually turned to support in today's trading. The greenback strength extended to some of our higher yielders, and the Aussie US dollar is one example where following the release we slid almost 150 pips, and gold today was down almost 4% or $50 to $1,170 an ounce, and that weakened some of our commodity currencies. As you can see, this week had seen the Australian dollar having a bit of a rounded top in this week's action. If we zoom this pair out even further, here we are in a 4-hour time frame. We see that this could be a very extended bit of a head and shoulders, as we had our left shoulder here, a high at 0.94, and then now we are back at this level as resistance. See? So here would be where the left shoulder, we did have already a test of this level, so it's not a perfect case, but it's still, this is the type of action you might see around a top. Switching gears a little bit, Canada also posted its employment change for November, and here too we saw a surprising result as the economy added 79.1 thousand jobs when expectations had been for a much smaller 15.3 thousand job increase. That helped the unemployment rate tick down 0.1% to 8.5%. So here we had full-time employment increased by 39,000 while part-time employment increased 40,000. That gain in full-time employment is the third consecutive monthly increase, while part-time work rose following 2 months of declines. Taking a look at the US dollar-Canadian dollar pair, we see that following the Canadian employment change, the Canadian dollar gained, hitting the 1.0430 level as a low, and however, following the Nonfarm Payroll report and the Greenback strength we saw overall in currency markets, the loonie did give up those gains, and we hit a high around 1.0595 in late New York trading. Some releases to look for next week in the US. We don't have much going on in the first half of the week, and then on Thursday we get data on trade and the weekly jobless claims figure, while Friday we get a measure of retail sales and consumer confidence. Around the world, we have 4 interest rate central bank decisions. We have Canada on Tuesday, from New Zealand on Wednesday, and then on Thursday both the Swiss and the Bank of England will decide on rates. So keep your eyes on those statements, as they'll provide some clues as to the future direction of each bank's policy. And that will wrap up this week's coverage of the Forex markets. For more news, analysis, and videos, including today's technical video recap, please visit our site fxtimes.com. I thank you all for watching, and I wish you all a great weekend.